In a market defined by uncertainty and rapid shifts, Bitcoin continues to demonstrate remarkable resilience by holding steady around the $80,000 level, even as the broader cryptocurrency landscape experiences another wave of sharp declines among altcoins, signaling a return to heightened fear across investor circles. Welcome to Crypto Hub, your trusted source for in-depth analysis of the digital asset space, where we cut through the noise to deliver clear, professional insights on the forces shaping the future of finance. Today, we delve into this critical development, examining the dynamics at play as Bitcoin maintains its position while altcoins face renewed pressure, pushing market sentiment into more cautious territory. The cryptocurrency market has always been characterized by its volatility, but the current divergence between Bitcoin's relative stability and the struggles of alternative coins highlights deeper structural trends that investors cannot afford to ignore. As of mid-May 2026, Bitcoin has been trading in a tight range near the psychologically significant $80,000 mark, fluctuating between approximately $79,000 and $81,000 in recent sessions despite broader macroeconomic headwinds. This holding pattern comes amid hotter-than-expected U.S. inflation data, including a notable surge in producer prices, which has triggered a risk-off environment affecting riskier assets across the board. Yet Bitcoin, often referred to as digital gold, has absorbed these shocks with more poise than many expected, supported by institutional inflows, ETF activity, and strong on-chain metrics that underscore buyer conviction at key support levels. This resilience stands in stark contrast to the performance of altcoins, which have once again entered a corrective phase with many tokens posting double-digit losses over short periods. Ethereum, the second largest cryptocurrency by market capitalization, has seen its price dip below $2,300, reflecting broader weakness in smart contract platforms. Tokens like Solana, Cardano, and various Layer 2 solutions have experienced even steeper declines, with meme coins and smaller cap projects facing liquidation cascades that amplify the downturn. The total cryptocurrency market capitalization has contracted, but Bitcoin's dominance has risen, a classic indicator of capital rotation towards safer havens within the crypto ecosystem during times of stress. This pattern is not new, but its repetition in 2026 warrants a thorough examination of the underlying causes and potential implications for traders and long-term holders alike. To understand the current situation fully, it is essential to step back and review the broader context of the 2025-2026 market cycle. Bitcoin achieved significant milestones in late 2025, pushing toward new highs amid optimism surrounding regulatory clarity, institutional adoption, and macroeconomic easing expectations. However, persistent inflation concerns, geopolitical tensions, and central bank policies have created a challenging backdrop. The recent U.S. Producer Price Index data, showing increases that exceeded forecasts, has reignited fears of delayed interest rate cuts or even potential hikes, prompting investors to reassess their exposure to high-risk assets. In this environment, Bitcoin benefits from its established status as a store of value, drawing parallels to gold and traditional safe haven instruments, while altcoins, which often thrive on speculative narratives and ecosystem growth, suffer from reduced liquidity and waning investor appetite. Analysts point to several interconnected factors driving this divergence. First, leveraged positions have played a significant role. Many traders entered long bets on altcoins expecting a continuation of the broader rally, only to face forced unwinding as prices reversed. Derivatives data shows elevated liquidations in the altcoin sector, creating a feedback loop where selling pressure intensifies and triggers further stop-loss activations. Bitcoin, by comparison, has seen more measured positioning, with its futures market displaying relatively stable funding rates and open interest that suggest stronger hands holding through the volatility. This dynamic underscores Bitcoin's maturing market structure, bolstered by spot Bitcoin ETFs that continue to attract steady inflows from traditional finance players, seeking diversified exposure without the operational complexities of direct custody. Furthermore, on-chain analytics reveal a tale of two markets. Bitcoin's network metrics, including active addresses, transaction volumes, and the movement of coins from exchanges to long-term storage wallets, indicate accumulation by sophisticated investors, Whale activity remains prominent, with large holders capitalizing on dips to strengthen their positions. In contrast, many altcoin projects show declining developer activity, reduced TVL in decentralized finance protocols, and lower user engagement, factors that erode confidence during risk-averse periods. The Fear and Greed Index, a widely followed sentiment gauge, has trended toward fear levels around 40-50, reflecting growing caution among retail and institutional participants. While not yet at extreme fear, this shift signals that market participants are prioritizing capital preservation over aggressive growth plays. Delving deeper into macroeconomic influences, the role of traditional finance cannot be overstated. Central banks worldwide, particularly the Federal Reserve, face a delicate balancing act between controlling inflation and supporting economic growth. Stronger inflation prints raise the probability of a more hawkish monetary policy stance, which typically weighs on risk assets like stocks and cryptocurrencies. Equities have also shown weakness in correlated sectors, such as technology, amplifying the spillover into crypto. Yet Bitcoin's decoupling narrative gains traction here. Despite these pressures, it has not collapsed below critical support zones, suggesting that its correlation with broader markets may be loosening as adoption deepens. Institutional reports highlight continued purchases via ETFs, with entities like BlackRock and Fidelity maintaining consistent buying patterns that provide a floor under prices. For altcoins, the challenges are multifaceted. Many projects launched during the previous bull run now face token unlock schedules that increase selling pressure precisely when liquidity is tight. Regulatory scrutiny remains a lingering concern, with ongoing discussions around securities classifications potentially affecting tokens with utility or governance features. Moreover, the narrative shift toward Bitcoin as the primary beneficiary of institutional capital has left many altcoins competing for a shrinking pool of speculative retail funds. Ethereum, despite its upgrades and Layer 2 scaling solutions, has underperformed expectations in this cycle, partly due to competition from faster chains and uncertainty around its own ETF flows. Solana has battled network congestion issues in the past, while newer entrants struggle to differentiate themselves in a crowded field. This environment fosters a survival of the fittest dynamic, where only projects with robust fundamentals, active communities, and real-world use cases are likely to endure and eventually rebound. Market psychology plays a pivotal role in these movements. Fear can spread rapidly in crypto due to its 24/7 nature and high leverage availability. Social media platforms buzz with bearish sentiment, amplifying downturns through herd behavior. However, seasoned investors recognize that such phases often precede consolidation or reversal setups. Historical precedents abound. Bitcoin has weathered multiple cycles of altcoin underperformance only to see capital rotate back during recovery phases. The key difference in 2026 lies in the scale of institutional involvement, which introduces more disciplined capital and reduces the likelihood of total market capitulation. Still, caution is warranted, as prolonged fear could test lower supports if macroeconomic conditions deteriorate further. Examining specific altcoin segments provides additional clarity. DeFi tokens have faced outflows as yields compress in a higher-for-longer interest rate scenario. NFT marketplaces report declining volumes, reflecting reduced discretionary spending. Meme coins, inherently speculative, experience extreme volatility, with many erasing gains accumulated over months in mere days. On the positive side, certain infrastructure projects focused on real-world assets or artificial intelligence integrations show relative strength, hinting at areas where innovation continues to attract interest, even amid broader weakness. This selective resilience suggests that while the market turns fearful, opportunities exist for discerning investors who focus on quality over hype. Technical analysis further illuminates the picture. Bitcoin charts display a consolidation pattern near $80,000, with moving averages providing dynamic support. RSI indicators hover in neutral territory, avoiding oversold conditions that might signal an imminent bounce. Resistance levels cluster around $85,000 to $90,000, where profit-taking could intensify on any upward move. For altcoins, charts are more bearish, with many breaking key support lines and facing potential retests of 2025 lows. Volume profiles indicate heavy selling at higher levels, necessitating a period of base building before sustainable recoveries. Traders utilizing tools like Bollinger Bands or Fibonacci retracements should monitor for signs of exhaustion in the current downtrend, though confirmation from on-chain data and macro releases will be crucial. Looking ahead, several catalysts could influence the trajectory. Upcoming economic data releases, including consumer price indices and employment figures, will shape expectations for monetary policy. Any signals of cooling inflation could reignite risk appetite, benefiting altcoins disproportionately due to their beta to Bitcoin. Regulatory developments, such as progress on clearer frameworks in major jurisdictions, might also provide a tailwind. On the adoption front, continued growth in Bitcoin Lightning Network usage, corporate treasury allocations, and emerging market penetration in regions like Latin America and Africa bolster the long-term case. For altcoins, successful mainnet launches, partnerships, or technological breakthroughs could spark sector-specific rallies, but these will likely require a more stable Bitcoin environment to gain traction. Risk management remains paramount in this climate. Investors should assess their portfolio allocations, ensuring diversification without overexposure to illiquid altcoins. Dollar cost averaging into Bitcoin during dips offers a disciplined approach, while setting clear stop losses and profit targets helps navigate volatility. Long-term holders may view current altcoin weakness as a buying opportunity for high-conviction projects, but thorough due diligence is essential to avoid projects with weak tokenomics or questionable teams. The market's maturation means that fundamentals matter more than ever, separating sustainable innovations from fleeting trends. As we synthesize these insights, the current episode of Bitcoin holding firm near $80,000 amid altcoin declines serves as a reminder of the cyclical nature of cryptocurrency investing. It underscores Bitcoin's role as the anchor of the ecosystem, a benchmark that influences sentiment and capital flows. While fear dominates headlines and short-term price action, the underlying trends of increasing institutional participation, technological advancement, and global macroeconomic integration point toward a more robust future for digital assets. Investors who maintain perspective, grounded in data rather than emotion, position themselves best to capitalize on eventual recoveries. The interplay between Bitcoin and altcoins reveals much about market maturity. In earlier cycles, everything moved in near lockstep, but today's environment shows greater differentiation. This is a healthy evolution, one that rewards research and patience over FOMO-driven decisions. As fear grips parts of the market, it also creates the conditions for future growth by shaking out weak hands and allowing stronger projects to consolidate. Monitoring Bitcoin dominance closely will provide early signals of when capital might begin flowing back into altcoins, potentially igniting the next leg of the bull market. In conclusion, the cryptocurrency space continues to evolve amid challenges and opportunities. Bitcoin's ability to hold around $80,000 demonstrates its staying power, offering a beacon of stability in turbulent times, even as altcoins navigate corrective pressures and the market registers increased fear. At Crypto Hub, we remain committed to providing you with balanced, professional analysis to help navigate these developments. Whether you are a seasoned trader or a newcomer to the space, staying informed and disciplined is key to long-term success in this dynamic asset class. Thank you for joining us today on Crypto Hub. Stay vigilant, manage risks wisely, and we look forward to updating you on the next chapter of this ongoing market story.